Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JOY City PPT interim report. JOY City Property Limited offers a diverse range of businesses and services, including real estate development and investment property management, and leasing hotel operations and ownership output management, and tourism services development and operation of mixed-use complexes and commercial properties, such as plus shopping centers, plus offices, plus serviced apartments, plus resort and tourist properties. The stock price of JOY City Property Limited, 207 HK, has skyrocketed by 204.81% in the past year due to a proposed share buyback and delisting plan announced on July 31, 2025. The company plans to privatize itself through a share buyback scheme at a premium of 67.57%, allowing it to delist from the Hong Kong Stock Exchange. This move is expected to streamline corporate governance, enhance decision-making efficiency, and improve financial performance by consolidating earnings into its parent company's financial statements. The market reacted positively to this announcement, with the stock opening significantly higher on August 1, 2025, indicating a favorable view of the privatization offer. The primary drivers of revenue growth for a company are multifaceted and varied. Key contributors include sales of commercial properties in the PRC, expansion into new cities, increase in number of JOY City malls, investment in premium properties, development of international luxury hotels, and output management projects. Additionally, household consumption has increased by 5% year-over-year, real estate sector indicators have improved, and policy opportunities have been leveraged. The company's revenue growth is also driven by its ability to adapt to changing consumer demographics and preferences. This includes the introduction of over 220 premium brands, regional first stores, city-level or higher first stores, and increased experiential activities. Furthermore, innovative promotional campaigns, upgraded membership systems, and precise engagement strategies have contributed to revenue growth. On the other hand, the primary drivers of revenue decline are largely related to cost increases and decreased sales. These include an increase in cost of sales and services rendered, a decline in rental income from investment properties, and reduced cash inflow for certain projects. Additionally, impairment losses and non-compliant structures have also contributed to revenue decline. Overall, the company's revenue growth is driven by its ability to adapt to changing market conditions, leverage policy opportunities, and invest in premium properties and international luxury hotels. However, cost increases and decreased sales have led to revenue decline in certain areas. Net income and profit margins. A shift in performance. The company's financial performance has undergone significant changes. Notably, net income declined by 11.4% year-over-year to RMB 671.9 million. This decrease is attributed to a decline in revenue and contracted sales. However, profit margins have shown an improvement. Gross profit margin increased by 2.9 percentage points to 34.4%, while core net profit margin rose by 25%. The property development business also saw its gross profit margin increase by 3 percentage points to 18%. These changes indicate a shift in the company's performance, with profit margins improving despite a decline in net income. The company's financial performance indicates a strong ability to generate cash from its core operations, with net cash from operating activities amounting to 844,131 RMB 0. The company is successfully converting profits into cash flow. This positive trend suggests that the business is financially stable and capable of meeting its obligations. The company's debt level and interest expenses have undergone significant changes. Notably, total interest-bearing borrowings have decreased by approximately 4.9%, indicating a reduction in the company's overall debt burden. Conversely, net debt has increased slightly, suggesting that while the company is paying off some debts, it is also taking on new ones. In terms of interest expenses, there has been a substantial decrease from RMB 969,098 to RMB 691,793, implying that the company is saving money on interest payments. This reduction can be attributed to lower interest rates or more efficient debt management strategies. Overall, these changes suggest that the company is making progress in managing its debt and reducing its financial obligations. The company's financial performance varied across different regions and segments in the recent period. Regions such as Beijing-Tianjin-Hebei, Yangtze River Delta, Guangdong-Hong Kong-Macau Greater Bay Area, and Chengdu Chongqing and the middle reaches of the Yangtze River performed well. In terms of segments, commercial and property investment and development showed significant growth, with revenue increasing by 7.6% in the latter. However, hotel operations, output projects, and other services struggled, with revenue decreasing by 0.3% significantly and slightly respectively. There were no notable acquisitions or divestitures in this period. The company's financial portfolio remained unchanged with no significant additions or disposals of assets. That concludes the financial summary for JOY City PPT. Feel free to comment below, and I will be happy to answer them when possible.